In June, nearly $2 trillion vanished from the markets in a single day. The selling was so aggressive that an entire national stock exchange had to halt trading. But within 3 weeks, stocks rallied right back to the edge of their record highs, exactly as if nothing had happened. We've seen this specific sequence before. You can think of it like a tremor. In March of 2008, one of Wall Street's most respected banks, Bear Stearns, completely fell apart over a single weekend. For a few days, panic set in. Then the market stopped panicking and actually went up. Investors decided Bear Stearns was an isolated glitch, and stocks rallied for months. 6 months later, Lehman Brothers collapsed, pulling the global economy down with it. Crashes follow a pattern, and right now, the market is sitting squarely in Stage 5, Delusion. This is the stage where incredibly smart people look at glaring mathematical warning signs and actively convince themselves that the old rules of gravity simply do not apply anymore. This chart tracks the Buffett Indicator, which compares the total value of the U.S. stock market to the size of the entire U.S. economy. Warren Buffett once warned that playing near the 200% line is playing with fire. The line on this chart is peaking right now at 238%, soaring well past the peaks of the dot-com bubble in 2008. A market being statistically expensive isn't enough to cause a crash on its own. The real danger begins when the entire financial ecosystem is running on the shared psychological belief that value doesn't matter anymore. The fatal flaws in our financial systems always hide out in the open, buried inside structures so complex that the people whose job it is to monitor them just tick a box and move on. Let's look at a diagram of how money is moving right now in the AI industry. It's a practice called circular financing. It starts when a chip designer like Nvidia invests billions into OpenAI. Step 2, OpenAI takes that massive pile of capital and commits hundreds of billions of dollars to Oracle to secure cloud computing power. Step 3 is where it gets strange. Oracle takes those same dollars and spends them buying computer chips from Nvidia. The exact same funds have traveled in a complete circle, landing right back where they started. Yet every time the money passes through a company, they record it as brand new consumer demand. Back in 1999, the most widely held stock in America was a telecom equipment manufacturer called Lucent Technologies. They lent money to startups who couldn't afford their gear. The startups used the loans to buy the equipment, and Lucent booked it as massive revenue growth. When the startups inevitably ran out of cash, Lucent's stock collapsed by 99%. Wall Street is pricing these AI giants based on the belief that this growth is permanent. But when you realize that roughly $1 trillion in deals is just looping around a small handful of companies, you see that the foundation of the boom is a mathematical illusion. A market dropping 10% is normal, even healthy. If house prices fell on their own in 2008, it would have been painful but survivable. What turns a standard correction into a catastrophe is borrowed money. Right now, the fuel is hiding off the public books in a sector called private credit. Over the last couple of years, direct loans from private funds have completely saturated the tech sector, to the point where AI-related deals recently made up roughly a third of all private credit issued. This diagram illustrates the core mathematical problem with these loans. A massive chunk of this private money was lent to software companies. If AI fails to deliver on its massive promises, those software companies wasted their spend, and the loans go bad. But if AI actually succeeds, it replaces the very software companies that borrowed the money, and the loans go bad anyway. It's a system designed to lose whether you pick heads or tails. Lenders are already seeing the cracks form. One closely watched measure of defaults in private credit has recently climbed to a record 6%. Those figures are rapidly approaching the extreme levels of stress we saw during the pandemic. So the problem with the AI ecosystem is twofold. It relies on circular revenue, and it is rigged with hidden off-book debt that is structurally primed to detonate, regardless of whether the technology itself actually works. If the math is failing and default rates are approaching emergency levels, it raises an obvious question. Why are the smartest investors on Wall Street actively choosing to ignore the data and buy in anyway? For the last 15 years, every time the market has looked down and seen the ground rushing up, a safety net has miraculously appeared. Rate cuts, emergency lending, and bailouts have trained an entire generation of investors to believe in the Fed put, a blind faith that the central bank will not allow the system to fail. You also can't wait for official institutions to confirm the danger. Global regulators and the US Treasury have only recently started drafting warnings about AI spending. By the time the government issues a formal alert, the risk is usually already old news. They warn you about a pothole that just burst your tire. Since a rescue is never guaranteed, the immediate practical move is to stop standing on the same side of the boat as everyone else. Right now, the entire index is leaning incredibly hard on about 7 massive tech companies. The easiest way to lower your risk is simply to spread your investments much wider than that crowded handful. It also pays to keep a meaningful cash position on the side. When that tremor eventually turns into genuine panic, the people with cash on hand are the ones who get to calmly buy up solid assets while the rest of the market liquidates in fear. Ultimately, nobody can perfectly time the top of a bubble, but you don't have to. You survive these cycles by identifying the historical patterns, stepping away from the shared delusion of the crowd, and patiently waiting for the math to finally break.